Good morning. Nice to see you all over the wire this morning. I'm going to start, as I always do, with our mission statement because I think it's so important to remember what it is that Custodian Property Income is aiming to do, and that is to be the real estate investment trust of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. And we will pick up all of those threads as we go through. But I'm going to talk really about three things today. I'm going to talk about timing, I'm going to talk about income, and I'm going to talk about risk. So let's start with timing. I've been saying all year that 2024 will be the year of recovery. Pessimists might say, well, you've still got 3 months to be right. But I would say we're already seeing that recovery. Let's look back. We had a really tough 18 months running into 2024. Inflation, rising interest rates, lack of confidence in the economy more generally. Across the whole market, property valuations fell from a rather inflated high in 2022 by up to 30%. Happily, and partly because of our very particular investment strategy, we saw only about an 18% fall in the underlying value of the properties in Custodian Property Income REIT. And through those 18 months, we saw very limited transactional activity. But the green shoots are emerging. We are seeing activity in the market. We've certainly seen since the start of this year stable capital values. We haven't yet seen the increase, but we have the portfolio revalued at the end of this month. It'll be interesting to see whether we are witnessing any growth in values. I would guess we're not going to see them this quarter, but maybe by the year end. Through the last couple of months, we've seen a real narrowing in the discounts of listed property companies. And importantly, and if ever you needed the evidence that a recovery is around the corner, we are seeing private equity back in real estate in quite a big way. And as we look forward, inflation seems to be, for the time being, under control. Interest rates, most forecasters are saying, should be cut once, if not twice, again before the end of this year. But through that difficult period, we have seen resilience in occupational markets. That's been delivering rental growth, while the investment market was looking the other way. And I think we are going to see catch up with investor sentiment, matching the occupier sentiment that has been very robust through the last 2 years. When we think about timing, it's been a real period of change in the listed property sector. There has been significant amounts of consolidation, with UK Commercial Property REIT being merged into Tritax Big Box, Secure Income REIT and LXI coming together, and then they, together with Columbia Threadneedle Property Trust, merging into London Metric. Tritax Eurobox, just announced in the last few days, is being merged into Segro. But we've also seen, and to my chagrin, we have seen listed property companies coming out of public hands and being taken private. We saw Ediston go to Realty Income in the States. Aberdeen Property Income Trust, we believe, is under offer to a private equity buyer at the moment. The Balanced Commercial Property Trust is under offer to Starwood. And in the unlisted space, we've seen a significant £600 million property portfolio called the Tiger portfolio just been put under offer to Lone Star. Being active in the market at the moment, as well as Starwood and Lone Stars, Blackstone, Ares Management, TT Group, KKR, Brookfield. If you ever needed to know that there was a recovery around the corner. I think the fact that private equity is stalking the market and doing deals should be fair warning. But following all this consolidation and these take privates, who does that leave in the diversified listed property company space? Well, it leaves just four: Picton, ourselves, Schroeder, and AEW. And I hope that when we've finished this quarterly update, those that have heard me before, you will be reassured. And for those that haven't, I might have convinced you that of those four, Custodian is the best offering. The market appears to be very well set for a recovery. It's not just the presence of private equity back in the market, but if we look at the slide on the left, this is looking at rental growth. And you can see that of the three main commercial property sectors, retail, offices, and industrial, all three sectors are showing positive rental growth. Now, we had extreme rental growth in the industrial and logistics sector. You can see that, the black line. But while the pace of growth has slowed, still strongly positive rental growth coming through. And retail has returned to growth after a very difficult period of maybe 4 to 5 years when rents were falling. So that appears to be well set. And then the chart on the right, which is research from Colliers, looks at in yellow the equivalent yield from real estate. And you can see that that has returned to a more normal level after equivalent yields fell as capital values grew very sharply in 2022 and then expanded as interest rates rising fed into sentiment to real estate, and we saw that fall in capital values. But the important bit of this chart to focus on is that margin between the cost of debt, probably the 10-year gilt is the best measure, and the equivalent yield from real estate. And you can see that is really widening to a much more consistent, so long-term average. And if we've got rental growth and equivalent yields remain constant, then we will see capital growth. And that's good capital growth. We don't really want to see capital growth from yield compression, because as we saw in 2022, you get yield compression, capital values rise, yields expand again, and capital values fall. What we want to see is good, solid capital growth based on the fundamental strength of that real estate, and the best measure of that is rental growth. And that's where we are. So really well set for a recovery. How's that played into Custodian Property Income REIT as we look back of the year to March? And this is a slightly funny time to be speaking to you. We have our September results will be out in October, but I think it's a very important time to be speaking to you because you don't want to miss this recovery. So what have we seen? We have seen earnings growth on the back of 5.6% rental growth over the course of the year to March 2024. That earnings growth has allowed us to increase the dividend by 9% from 5.5p to 6p per share. And we've been able to do that at the same time as selling £30 million worth of property, £29.5 million worth of property at 24% ahead of valuation. And that is not just sticking properties in the market and hoping for the best. That's a very targeted approach with special purchases. So we've sold to owner-occupiers, we've sold to developers where we have achieved advantageous planning permissions on our existing assets. And that £29.5 million worth of sales has both funded the essential capital expenditure that is required to maintain a modern and fit-for-purpose investment portfolio, but it has also enabled us to bring down the loan-to-value from a little over 30 to 27.9%. And bringing down that loan-to-value was important because what we were paying off was our relatively expensive variable rate debt in our in our revolving credit facility, and that was bringing down the weighted average cost of debt from a little over 4 to a little under 4%, which is, of course, enhancing for earnings. And this is all part of the strategy to give us the maximum headroom to pay dividends and see future dividend growth. When we look at rental growth in hard numbers, in the top left of the screen, you can see the passing rent from our portfolio is 43.1 million, and the potential rental growth comes from the reversion, the estimated rental value, the ERV of the portfolio. There's 2.2 million to come through there, but also there's 4.1 million from the letting of vacant space. But if we're realistic, we're not going to be 100% let anytime soon. So on the right is a forecast of how we think that contractual rent will grow over time. Now, the keen-eyed among you will notice that rents are forecast to fall in 2026. In this forecast, we make the very conservative assumption that at the end of every lease, our tenants will leave, there will be a period of vacancy, and then we will re-let. However, our real life experience is not nearly as pessimistic as that, and we have tended to see that tenants stay at the end of the lease. So this is a conservative forecast based on contractual income and those slightly pessimistic assumptions that all our tenants leave. And the reason we run our forecasts like that is because we want to make sure that we don't trip ourselves up and find ourselves with an uncovered dividend 1 or 2 years out. In the bottom left, and I think this is the chart for the optimists, what we can see here is the reversionary potential of the portfolio going back over time. So what it will show you is back in March 2014 at IPO, we had a portfolio that was very marginally over-rented. Through the next 6 years, the portfolio was broadly rack-rented. We weren't seeing huge amount of rental growth. But in 2020, we start to see that rental growth feed into the portfolio. And one of the challenges investing in real estate is you have to be patient because you don't get that rental growth on day one. You can see that rents are growing, but you might not have a rent review, you might not have a lease renewal, which of course is your opportunity to increase those rents for 1, 2, maybe even 5 years. So that reversionary potential will feed into the portfolio over a period of time, and we're certainly seeing that at the moment as we commented just previously, a 5.6% rental growth in the portfolio last year. But the important thing is that reversionary potential, 15% reversion, is the highest it's been for 10 years. So yet again, really pointing to the fact that this is a very opportune time to be re-engaging with real estate. Let's look at some property. Okay, that's what this ultimately. This is what it's all about. And you can see here in our industrial and logistics portfolio over the course of the last 12 months what rental growth looks like. We have been granting reversionary leases. That is where we have a lease maybe for 2, 3, or 4 years, and the tenant is keen to stay longer term. So they take a lease that starts in 3, 4, or 5 years' time when their current lease expires, and that gives them that longer certainty of occupation. So we've granted reversionary leases and are showing a 64% increase in the rent in Warrington. Lease renewals, 62%. Rent reviews, 42% in Normanton, 33% in Salford. And you can see the numbers. I don't need to read them all out. But really strongly positive rental growth. And where's it coming from? It's coming from that strong occupational demand married to limited supply, very little development in our particular market, which is, to overuse property vernacular, small and mid box industrial rather than the great big box logistics units that you might see on the side of the motorway. These are the same sort of tenants, just in smaller units. There has been build cost inflation, which has limited developers' ability to build, or indeed it has required them to charge higher rents if they are going to build. and all of that has fed through to very positive rental performance. And here's an example. This is a property that we've owned for a number of years in Winsford in Cheshire. And the picture you can see here is following a refurbishment at the end of the lease to the outgoing tenant. We refurbished the building. We improved the environmental performance certificate from a C to an A. So it's fully electrified now. So we have capped off the gas supply, got an air source heat pump heating the offices. We've got solar panels, which you can see there on the roof. And the tenant has entered into a contract that runs alongside their lease to purchase that solar generated electricity from us. They get a discount to the cost of buying the electricity from the grid, and we get a return on our investment. They've taken a new 10-year lease, and the rent has gone up 18%, and the value a little over 20% as a result of this refurbishment. But it's not just about the industrial and logistics sector. You know, many people have said over the last years that, most particularly the last 2 years, that offices are a toxic investment. They're uninvestable, and they are all stranded assets. Not true. Yes, of course, there are some difficult assets in all sectors, and perhaps more in the office sector than in others. But two very positive examples of rental growth with lease renewals in Oxford and Leeds, where we've seen 58% and 45% increase in the passing rent. And in the sort of other sectors, car showroom in Loughborough, 13% increase in rent. In Milton Keynes and in Crewe, we let 2 buildings on 25-year leases to 10-pin bowling. And that shows real confidence from the occupiers taking those very long leases. And we're starting to see rental growth come back into both retail warehousing, and I think there's quite a lot more of that to come, but also on the high street. But it's not all high streets. Small market towns, where it tends to only be convenience retail, still very difficult. But where you have perhaps destination shopping environments where there is both retail and leisure combined, and it's a day out for the shopper, then the retailers are reacting to that by demanding the best units, and we're seeing rental growth. And you can see both in Shrewsbury and Edinburgh some very strong rental growth against the previous passing rents. So there is good news across most sectors. Here, in fact, are those offices in Leeds that they talked about. These are 2 buildings in Leeds city centre. They have been occupied by Enact, who are a legal conveyancing business, for the last 10 years, and we've owned them for 9 of those years. And we have recently renewed the leases on both buildings. But in order to do that, we asked the tenant to squeeze up into the building on the left while we refurbished the building on the right. Then they moved into the building on the right as we refurbished the building on the left, and they have now spread back out across the 2 buildings. And that's shown a 45% increase in rent and a 40% increase in value, while at the same time improving the environmental performance of that building. So the EPC has gone from a C to an A. So that's all I've got to say on timing. Income, and I talk about income a lot, and you'll know why as we go through this. It's so central to real estate investment, and it's absolutely the focus of the Custodian Property Income REIT strategy. We look for higher risk-adjusted income returns from diversified regional commercial real estate. And as we say here, that's our DNA. And what we're trying to do is to provide access to that diversified UK real estate in an institutional grade package. Since producing these slides, and they're based on numbers as at the end of June, we have seen very strong recovery in the share price. So perhaps many of our shareholders have already identified that the recovery is coming. And since a low point in June, our share price has recovered 20%, and there has been some very strong share price performance just over the last 2 weeks. And perhaps it's picking up some of the themes that we've been talking about. I think it's always worth revisiting this slide, which is at the core of our DNA, and it answers the question, why do we buy smaller, diversified, regional assets? And it is all about income. So what the chart is showing is the transaction yield of properties that have traded in the market over the last 24 years. The dark blue line represents properties with a lot size of under 10 million, and the light blue line, properties of over 10 million. And for the first 10 years, you can see there was a very consistent and narrow margin. And let's call that the risk premium. It's about 65 basis points. Probably some of that was just couldn't be bothered to manage a large portfolio of small properties. So there's a bit of hassle factor in there. So let's call it a 50 basis point risk premium. It also makes the maths a bit easier for me. What have we seen since then? We've seen an average 150 basis point margin since 2010. And what happened in 2010 was not a change in the risk profile of smaller properties versus larger, but it was a change in supply and demand. We saw greater demand from a wider range of investor strategies pursuing relatively large, relatively prime assets, and at the same time divesting themselves of their smaller, can't be bothered to manage properties, so increasing the supply and reducing demand of those smaller properties. But if the risk premium was only 50 basis points, and the margin now, and consistently has been since 2010, 150 basis points, then we would argue that we're getting 100 basis points of return for taking no additional risk. And I don't see that gap closing in the near future. So we think that our strategy is still set fair. We've always paid a fully covered dividend. We think that's very important, and this chart shows that in a very simple form, with the light blue bars being earnings per share and the dark blue being dividends per share. We, in line with many others, were forced, I think is probably the right terminology, to bring down our dividends per share in COVID, and you can see that. The expectation was that we would increase those as we were able to do, but as we've come out of COVID, we have seen an increase in the cost of debt. So I don't think in the next 5 minutes we're going to return to 6.65 pence per share. But what you can see is that absolute commitment to growing the dividend where we're able to, based on earnings growth, which is based on rental growth. So I think the prospects for future growth look reasonable. This chart is one we've looked at for the first time when we reached our 10-year anniversary, and it's looking at our performance versus the benchmark. Now, we have always shied away from benchmarking. Our fear with benchmarking is that you end up with a subset of what everyone else has got, rather than investing with absolute conviction. And our conviction has always been that income is sacrosanct, as is the fully covered dividend, and we have asked shareholders to judge us on that and that alone. But when we look back over 10 years, this rather messy chart shows Custodian REIT in the dark blue, and perhaps the key benchmark to focus on, which is the FTSE EPRA REIT UK index. So it's basically the whole of the listed property sector down to sort of market cap of about 450 million. That's the grey line. And over those 10 years, the share price total return differential has been for Custodian positive 55% and the benchmark positive 29%. So it's a very significant increase. Now, if you'd asked me 10 years ago, is this what we would forecast? I think I would have said, with a degree of confidence, and I hope not arrogance, that yes, it is what we would expect. And the reason we expect it is because since 2014, and I don't know if any of you can conjure up the chart we looked at a little earlier that was looking at the equivalent yield for real estate. Equivalent yield for real estate then and now are the same. So if we just look at our portfolio, we have we launched in 2014. The equivalent yield of the portfolio then was about 7.5%. We saw significant yield compression through those years, particularly sort of 21, 22, and then yield expansion. And our equivalent yield today is about 7 to 7.5%. So we and the market has seen no explicit performance through yield compression for those that have remained in. If you get out at the top, well, great. But for those who have stayed in, no particular performance linked directly to yield compression, because yields have compressed and then expanded. But each and every year, we've paid out more dividend than most of our peer group, and certainly most, if not all, of the benchmark. And it's that recurring income return. And this isn't compound return. This is just absolute return. And if you were to compound it, the figures would look even better. But it's that recurring high income that delivers outperformance over the medium to long term. So we've talked about timing and we've talked about income. And of course, the next most important component of investment to go alongside income and return is risk and or diversification. And the two, of course, go hand in hand. Our portfolio is broadly spread across the UK. And you can see in the chart on the right that very diverse portfolio supporting the earnings are over 300 tenancies in 150 properties with an average lot size of just under £4 million. And you can see perhaps more easily here, this is the sort of assets we own. They are modern, fit for purpose properties, and they are weighted to the sectors where we think there is the most rental growth. So particularly industrial and logistics, and you saw the chart earlier, a very strong rental growth that there has been in that sector that is still persisting. A return to rental growth, we believe, is absolutely knocking on the door for retail warehousing, a sector where there is almost no new development. Planning authorities have realized, and shocking, isn't it, that it's taken them 30 years to work it out, that if you continue to build retail parks on the edge of town centres, the town centres will suffer. But maybe as shoppers, that's no bad thing because they are terribly convenient and we like them, the retailers like them, and we are seeing strong demand and a return to rental growth in that sector. Even in offices, there is rental growth, and I gave you two examples of that. But here we've got properties shown on the screen in central Birmingham, a building we bought when rents were £12.50 a square foot. They're now £19 a square foot. It's a very meaningful rental growth. And while values haven't reflected that positive occupier sentiment of late, the cash flow has been absolutely essential in driving the earnings growth we've seen over the years. And then pictured below that is a building in Edinburgh Park, where again, so this is between Edinburgh city centre and the airport and on the tram link, where we're also seeing a return to rental growth. We've seen growth in drive-through coffee shops, and that's a Starbucks unit that we have in South Birmingham. And we've also seen demand from gym operators, and that's a Ballantyne's Health and Fitness Club, where they have taken new long lease, really showing a commitment to the location. And a recovery in high streets. Two photographs shown, one is Chester, which is absolutely a destination location, and beneath that, a shop in St Albans, which again is a very strong retail location. When you talk about risk, you have to consider diversification. And I think Custodian Property Income REIT has one of the most diversified portfolios, certainly as a proportion, as a relative to market cap. It is the most diversified portfolio by tenant and by sector and by income. And what this chart is showing you is the amount of income that's paid by any one tenant in the portfolio. And even amongst our largest tenants, so take Menzies Distribution, we have 8 properties let to them. So there is further diversification within each of those larger slices of the pie. But what it means is we have no one property let to any single tenant that represents more than 1.5% of the rent roll. So genuine risk mitigation through diversification. But it doesn't mean, because we have this large number of smaller properties, that we need to compromise on the quality of tenant. And you can see amongst our top 25 tenants, many names, if not most of those names, that you will recognize. But if we look at the quality of our tenant by reference to an Experian credit rating, you can see in this chart that over 80% of our portfolio are considered lower than average risk. So good quality income, well diversified, is a huge mitigator of risk. One of the risks that I think has contributed to the decline in sentiment to real estate through the last 2 years, which I believe is about to reverse, and we're going to see more positive sentiment, has been the cost of debt, particularly the cost of debt versus the income return from property. Because of our strategy, focusing on those higher yielding properties, those properties that deliver a higher income return, what we're looking at here is, in the dark blue, our weighted average cost of debt, and you can see how that increased as interest rates rose from 2022, and that the increase was all in our revolving credit facility. We've got 4 tranches of debt, 3 of them are fixed, and 1 revolving credit facility. And that revolving credit facility increased our weighted average cost of debt to just over 4%. It just then come back down to just under 4%. But through that period, if you then look at the light blue line, that is the initial yield of our portfolios, that is the income we're getting today, and then the grey blue tranche on top is the reversionary potential of those properties. So as that rental growth comes through, you can see we are maintaining a very wide margin over the cost of debt. And I think that Custodian perhaps got pulled down with everyone else, which is what you'd expect in a listed sector. And I don't think we got due merit for the wider margin over the cost of debt that we have maintained through our particular property strategy. But of course, that has given us a great deal of confidence and enabled us to increase the dividend, knowing that we still have that wide margin over the cost of debt. And that's the cost of debt that we're now hoping to see come down. And you can see on the right, the forward curve for 3-month SONIA. The line marking July next year is the first refinance point we have in our portfolio. So looking at the bar chart on the left, 4 tranches of debt. The first fixed rate debt, which expires this time next year. It's a £20 million facility. Current cost of debt 3.94%. 3-month SONIA is forecast at that refinance date to be 3.9, with a margin over the cost of debt. There might be a slight increase to the debt servicing cost for Custodian, all things being equal, but we might see further falls in interest rates between now and then that are not forecast into the forward curve. But that increase in cost of debt is less than 1% of the rent roll. So very affordable, and particularly with the rental growth that is dropping into the portfolio between now and then. And then we've got a revolving credit facility. We have been paying that down, that relatively more expensive cost of debt, but we still benefit from those two long-term fixed rate facilities that run till 2028 and 2032. So no imminent refinance risk, and certainly it's looking pretty comfortable when you consider our forecast for income. So that's me complete, subject to any questions. But to reiterate, timing, income, and risk.
Brilliant. Thank you very much, Richard. Just to remind those on the call, please use the Q&A button at the bottom of your screen to submit any questions. But we have a number, so I'll just start going through them now. What is the likely impact of private equity on the availability of properties and rents? Will it make growing the portfolio more difficult and possibly more expensive?
I think that private equity coming back into real estate is strongly positive. Unfortunately, there are more followers in the market than there are leaders. And that's probably true of all markets. And a lot of those followers have been waiting for two things. One, for falling interest rates, which we've had the first cut and more are forecast. And secondly, the absolute certainty that they will not be left high and dry if they move early into the market. And I think private equity leading from the front is strongly positive for the investment sector. In terms of the specific question, will it restrict access to properties for Custodian to invest in? No, I don't think it will. For the most part, we swim in a slightly different pond to a lot of the market, and we talked about it earlier. And if I just flick back to that important chart, the greatest weight of demand is tracking that light blue line, that relatively large, relatively prime asset. And of course, there are fewer of those than there are smaller properties, which litter the country from Aberdeen to Plymouth and from Chester to Norwich. And we are investors in all of those markets. So I think we don't see that as a problem. And in fact, I think private equity is strongly positive for the sector as a whole.
Is it possible to maintain earnings whilst meeting the cost of environmental improvements required by legislation? But on the EPC upgrades, how has the attitude to these changed? And have the outcomes of these upgrades been as expected, or better or worse?
This is something that I think really concerned people a few years ago. When environmental legislation started to bite hard on commercial property landlords, there were a number of shareholders at the time who were very concerned that the cost of meeting the legislative requirements of net zero would be at the expense of dividends and dividend growth. And I think perhaps 5 years ago, there was reason to be concerned, because 5 years ago, our tenants in general, weren't that interested in the environmental agenda. But life has moved on, and it's moved on very, very quickly. And we now have tenants absolutely aligned with the requirements that are imposed upon us by legislation, and indeed a moral imperative to do something about climate change. And where we have created buildings with improved energy performance, as evidenced here and in the other example I gave you, an industrial unit with the improved EPC, we have seen tenants commit to longer leases, paying higher rents, and those buildings have let quicker. In fact, I would go one stage further. If we don't do that work as property fund managers, we are letting everybody down, most particularly our shareholders, because we get a return over and above the cost of the environmental improvements, both in income and in valuation, by engaging with the environmental agenda. And it's just become how you manage real estate now. To overlook it would be madness. And we have had a real push over the last 3 years, which is now starting to bear fruit, putting solar PV on our industrial buildings. We are about to engage with some of our retail warehouse tenants for the first time. So our largest tenant, Menzies Distribution, and as I said, they've got 8 properties, and we've got solar PV on 7 of those. The 8th, we would like to put solar PV on, but there isn't sufficient capacity in the local district network, so we are precluded from doing it by grid capacity. But 7 of those 8 properties now have solar PV, and we are getting additional cash flow from properties that we already owned, and typically forecast returns. And I say they're forecast returns because none of these installations have been installed for long enough that we can say with absolute certainty that these will be the returns. But forecast returns are in the order of 3 to 7 year payback, depending on the number of panels, the location, which way the roof faces. But 3 to 7 year payback is slightly higher return than we're getting from leasing real estate.
Excellent, thank you. We have a question here. Your cautious view on what happens to rent at lease end sees a dip in rent in 2 years or so. Do you have a lot of lease breaks or completions coming up? And what does the schedule of expiry look beyond that?
With over 300 tenancies, it's almost a non-stop conveyor belt of lease expiries. So an average unexpired lease term is 5 years. So you would expect that 20% of your leases come to an end or have a break in any given year. So 2 years out isn't a particular dip. What we'll probably find, and if I were to dig out the forecast model, we might have a couple of larger properties that are weighing more heavily on that forecast with lease expiries in that year. But as I've said, and here is a great example. These 2 buildings in Central Leeds, the lease came to an end, and there has been no gap in income. But we would have forecast that there would have been a gap in income, and I think we've had that debate with ourselves. Should we be more optimistic in our forecasts? The trouble is, you've got to plan for the rainy day. If when we get there we've got more earnings and more income capacity, then that's terrific. But what we don't want to do is find that we have committed to a dividend that becomes unaffordable because our worst fears are played out. So I suspect it's a couple of significant tenants who have a lease expiry. Just to give some comfort around that, we start talking to our tenants at least 18 months before lease expiry. So we very rarely get a surprise 2 or 3 months before lease end as to what that tenant's intention is. And 18 months out, we are able to negotiate with the tenant, really find out what they want, whether they want to stay, whether they would stay if we refurbish the building, whether they would stay if they could maybe take less space in the building, whatever it might be. So we, as we get closer to these lease expiries, so that forecast model will change, and probably we will see that fall in rent pick up as we have more certainty around what's going on at lease expiry in those particular tenancies.
M&A and wind-up activity in the sector is evidence that property REITs are being undervalued. Are you expecting to see pockets of value pop up in the smaller lot property subsector as this consolidation unfolds and portfolios are rebalanced, reconstituted, or sold off?
One of the, I think, direct consequences of the consolidation and the growth in fund size is that the small lot size sort of diversified portfolio that we like to own and would like to build is going to become even more overlooked, because as a proportion of the whole, a £4 million property in a £6 billion fund is really below anyone's interest. Whereas for us, it's our average lot size, and it's still very important. So I think, if anything, the opportunity set is going to increase, not decrease, as we see further consolidation. Now, a number of you will know, if not all of you, will know that we tried to merge with Aberdeen Property Investment Trust earlier in the year. And it remains very disappointing that a very small set of API's shareholders favoured a wind up of the business over the continuance of that business in a newer, larger portfolio with Custodian. That portfolio is currently under offer at about a 15% discount to net asset value. Is the best guess that we've got using the market intelligence that we can uncover, and that's set against the offer that we made to buy that portfolio for net asset value. And when we were considering that merger, a number of people asked us, are you now, if you grow to £1 billion of gross assets, are you going to start buying larger properties? And the answer then, as it would be today, is no, because that's not where the opportunity set is. The opportunity set is by finding those modern, well-let properties, let to low risk tenants, where there is a marginal income return because they're considered too small for institutional investors or larger real estate investment trusts. So a lot of this, I think, really plays into Custodian strategy very strongly.
Excellent, thank you. Is the diversified versus specialist approach more attractive at the moment, with your ability to tactically shift subsectors depending on those valuations? Are you seeing any particular areas of concern or opportunity in all the subsectors in which you invest?
Listen, I'm a strong advocate of a diversified strategy, and for a brief moment, I thought, well, maybe we've finally come in vogue as Tritax Big Box bought UK commercial property and became a diversified fund. But they have subsequently said they are going to refocus on industrial and perhaps sell down some of their non-industrial assets. But even they've diversified from big box into mid box. So I think diversification shouldn't be overlooked. One of the things that has troubled me over the last few years is that we've gone from single sector fund to sector specialists to pure play funds. And as we keep layering on euphemisms for these strategies, we are getting further and further away from what we should be saying. And that is that a single sector fund is a high risk fund. But high risk is also high return when the market is with you. And that's been absolutely evident for the likes of Segro and Tritax Big Box. With a wind behind them, those single sector high risk funds have delivered fantastic returns. But they also caught a real cold in 2022, from which they've largely recovered. But in 2022, it was really difficult, suddenly being in a sector that was hit very, very hard by the increase in interest rates, much harder than we were with a more diverse base. And that's why today I've been talking about timing, income, and risk, because risk needs to be talked about properly and not with euphemisms. We need to really understand what it is we're saying when we talk about a pure play fund versus a diversified fund. I think the other thing I would say about the diversified sector is it's got a real place, not just for institutional investors, but perhaps most particularly for retail and smaller private wealth investors who might not have access to all the research that is available to larger investors, want to invest in real estate, but perhaps don't know when the best time to get into one sector and out of another sector is. But that diversified income-focused strategy, as we saw in our 10-year return, that income strategy that comes from a diverse portfolio that has been built over 10 years. And for some of those years, even though we favor the industrial and logistics sector, and it's 40% of our portfolio, we were buying retail warehousing because we thought that industrial and logistics were overvalued. And that's not available to the pure play funds. They have to keep buying in one sector. So for all of those investors that don't have access to the research or indeed don't have the energy to be tracking the market every 5 minutes to know exactly when to get in and when to get out, for a long-term income-focused holding, then a diversified portfolio, I think, is the very best fit.
Excellent, thank you. What has been the cause of delay of share prices to reflect this higher reversionary potential, do you think? For companies, you'd expect the share price to discount these expected earnings increases. But is there a peculiar overhang for REITs due to sentiment or any other reasons which might have caused this pressure or downward pressure on the share price?
Yeah, I think there are two things at play. The first is that in common with every bubble that has preceded it, and probably every bubble to come, in 2022, market values expanded rapidly before collapsing pretty miserably on the back of the increase in interest rates, or the mini budget, if you want to give Truss and Kwarteng another kicking, but probably it was interest rates that did the most damage. And people got quite hurt by that. And that sentiment has taken some time to recover. I think the other problem, and this is perhaps a longer term problem, is the sector's over-reliance on net asset value as a measure of worth. And what has been demonstrated very clearly with Balanced Commercial Property Trust and API and others that are now being sold down at 10 to 15% discounts to net asset value, that net asset value has already proving not to be a very good measure of what the underlying portfolio is worth. But that's quite a backward-looking way to look at it. When you're buying into, when you're investing into a real estate investment trust, what the properties were worth 3 months ago, which is what really net asset value is telling you, doesn't tell you what's going to happen next. What tells you what's going to happen next is earnings and earnings growth, because they support dividends, and dividends make up 75 to 80% of total return from real estate. So this over-reliance on net asset value as a measure of worth has kept the lid on sentiment, because limited transactions in the market, relatively high interest rates have depressed values, even though rents were growing. And people seem to be blind to that rental growth because they were fixated on net asset value. If instead they had been fixated on earnings and the earnings growth that has come through from the rental growth, albeit tempered by the increase in interest rates, then I think we would have seen a different picture. So I think those two things have played apart, and perhaps in the short term, it's that sentiment hit from the bursting of the bubble that has been the real villain of the piece. But the longer term, over-reliance on net asset value, I think, gives people a distorted view of the true worth of listed real estate.
Do you have any views on why some people, investors, still see smaller, less expensive properties as having lower quality tenants and therefore somehow more risky, when actually the credit quality, as you've shown, is clearly strong? Is it a matter of just big is shiny and beautiful, or do people want to say that they can own these enormous buildings when the smaller ones seem to be slightly less sexy, I suppose?
I think again, there are a couple of things that influence that. One is just simply the way we all use language. Fast is better than slow. That's why we're currently spending 100 billion on a train that goes from London to Birmingham, because we're told that it was going to be high speed, but actually it's no better than the one that already goes. That's by the by. Fast is better than slow. Big is better than small. Tall is better than short. This is sort of the way people have tended to consider things and use of language. So I think that's that plays around the edges. I think perhaps more powerfully, the impact of everybody else in the market saying we're increasing the average lot size of our portfolio. This is a good thing for shareholders. When you unpick that and you see what people are doing when they increase the average lot size of the portfolio, they're selling properties yielding 6.5% to buy properties that are yielding 5.5%. That's giving income away. Now, it may be they're getting more rental growth out of those properties in any particular transactions. You can't write all transactions like that off as being the wrong thing to do. But we've seen a lot of it over the years, and we've been net beneficiaries as buyers over the last 10 years of institutional investors selling down their smaller properties because they're no longer set up to manage a large portfolio of smaller properties. But I think so. I think that's probably the fact that everyone else is going the other way, and the herd mentality it's quite difficult to fight against. But we still see real opportunity to drive out those higher dividends from and let's face it, the very nature of buying smaller properties is you have more of them, and therefore you get greater diversification, which mitigates risk.
Excellent, thank you. And just and finally, can you elaborate on some of the new office space buildings that you've recently renovated and relaunched? Some of the investors, obviously, as you said, are a bit more pessimistic on the office idea, but clearly you've been doing a lot of work on some of that yourself.
Yes, I think that the office sector of all the commercial property sectors has always been the most difficult to invest in, because office buildings suffer the fastest rate of obsolescence. So the space that you occupy becomes out of vogue much more quickly than a high street shop, for example. And high street shops look the same now as they did 30, 40, 50 years ago. And indeed, many of our, we've got high street shops in buildings that were built in the 18th century, and they're still operating as high street shops today. So there's been very little obsolescence in those buildings. But no one is operating out of 18th century offices that haven't been significantly refurbished multiple times over the years, probably knocked down and rebuilt multiple times since the 18th century. So office buildings have become out of vogue quite quickly. And what we saw through COVID was an acceleration in the obsolescence of office space. So what has become unfashionable is large floor plate, out of town business park offices, because an awful lot of employees in those locations say, well, listen, I can do this just as well from home. There's no point in me taking the bus to the business park because I can't park because there isn't enough parking, and the planning authorities won't allow more parking because they're trying to wage a war on cars, to the business park to sit on a small desk in a row of 100 people with a headset on. That is low quality of life, and I'm no better at my job doing that. So a lot of those employees have voted with their feet, so I'm not coming back. So then the employers have taken a look at the space, and some have tried to mandate people back to the office, and that, in my experience, I think that's been broadly unsuccessful. People tend to say, well, if I'm being mandated back to the office, but I don't want to come back to the office, I'll look for another job. So I think the more successful employers have created office space that people want to come to. And so what does that mean for us as landlords? It means we have had to provide a much higher level of amenity in our offices than we ever needed to do in the past. In the past, you would paint the walls white, you would fit grey carpets. They were blue in the 80s, but they've been grey recently. And you would wait for a tenant to turn up who would fit the building out themselves at their cost. And at the end of their lease, they would strip it all back and give it to you back with white walls and grey carpets. And if they were taking a 10-year lease, that was a perfectly reasonable thing to do. But tenants now are thinking, well, if I can commit for 10 years, we want a 5-year lease and we want a break after 3 years. And if we're only going to be there for 3 years, we're not paying to fit the building out, only to rip it out, put it in a skip in 3 years' time, to give you back the white walls and grey carpets. So we have been fitting the space out for occupiers. And most occupiers, if you provide them fitted space where they won't suffer a dilapidations bill at the end of the lease, are happy to pay a much higher rent to pay for that fit out, have the benefit of up-to-date modern space. And in that fit out, we include, none of this is particularly new or exciting. You've all seen it in your own offices, but it's not always provided by the landlords. But now landlords are providing fitted space, sometimes with desks and chairs, with breakout areas, with meeting rooms already in place, with large usable kitchens, with big tables, business lounges, hotel quality showers and bike storage, EV chargers in the car park, maybe in the basement. These are all things that, if you provide, they are strongly in demand by tenants, and they will pay good rents if you do that. But it's about providing that quality of space in locations that are also rich with amenity. So good public transport, shops and restaurants at lunchtime and in evenings after work. So that really works against regional business parks, and we've been actively selling. In fact, we've just agreed the sale, completed the sale today of a business park office we had at East Midlands Airport in the East Midlands.